we live in a world where there's so many things happening, and all these things have an influence on markets. But the principal driver of, say, financial markets, of stocks and bonds, has been monetary policy in the Western world. And that has made any precise assessment of the strengths of an economy very difficult. Because let's assume you tell me, Mark, how are you? And how is your business? I'll tell you everything is great, but I don't tell you that everything is great because I just got a loan of, say, $100 million, which I know I will never be able to pay back, but I can spend it. And so by spending it, I live a very great life. And maybe one day a bank will have to write it off or something like this. But the money that I got free of charge from whatever, the government or the state or the bank, allows me to live way above my standard of living. Doesn't mean that it's sustainable. That is the point. And when you ask me about the global economy, I think we are in a surreal economy in the sense that the typical household, according to statistics, at 35 years of age, is less wealthy than the parents were when they were 35, and they earn less in real terms, inflation adjusted, than they were 35. Number 2 point I'd like to make is we have today a rate of inflation, and we have to define what this inflation is. When stocks go up, when properties go up, is this inflation or is it a bull market? There are many interpretations. But basically, inflation is excessive printing of money, an increase in the quantity of money. So something will go up. So it can be that, say, commodities go up, and it can be that stocks go up. It could be that bonds go up. It could be that houses go up, and cost of living, and so forth and so on. But say, for most ordinary people, inflation is an increase in the cost of living. Now, the cost of living at the present time, and you have a household and you have maybe children, and I have also children, but my daughter is already grown up. So your rate of inflation is a different one than mine. But say, if I look at all the literature about inflation at the present time, it has to be in the United States between 7 and 12% per annum, depending on the household and where you live and so forth. But in some areas, rents have gone up by 20% over the last 12 months. And in other areas, less. And then if you own a house, maybe you don't feel it that much and so forth. So it's difficult to calculate, but I think a fair assessment would be to say it's between 7 and 12%. Now, the last time inflation was this high was in the 70s. But at that time, the Fed fund rate was around 8%. And now we have central banks in Europe, they think inflation is transitory. So, they don't need to do anything. And in the US, the big debate, there's a big debate, is whether to increase interest rates from 0 to 0.25 or 0.50. You understand? This is a surreal world. Interest rates, when the rate of inflation is this high, should be, say, on the Fed fund rate, 6 to 8% minimum. But we are there at not even, but they haven't increased it yet, and they're still buying assets. You have to see this, they're buying assets. They haven't stopped printing money, not at all. And so I don't know what the outcome will be, but I can't imagine that it will be a favorable outcome in the long run. And in the meantime, I'd like to just say one thing to everyone. When I grew up in the 60s and 50s, My grandparents always said, you know, you have to save some money and you put it in the bank and then you have some reserves. Today, money in the bank and reserves is about the worst thing you can have, because in a year's time, through this inflation I explained, it will be worth 7 to 8%, maybe 12% less than it is today.